Let's focus in on Malaysian stocks now because they surged 51% last year. The market actually lagged the rest of the region. The MSCI Asia ex-Japan index soared 73% during that period. And our next guest in Kuala Lumpur is the managing director and also chief investment officer at Amara Investment Management. Let's talk to Johan Ngo about whether Malaysia is a better bet this year, maybe a better laggard play, or if he still favors other Asian markets. A happy new year to you, Johan. So let me just ask you, what kind of year will 2010 be for Malaysian stocks? We're looking at the KLCI at 1284 and change at this point. What kind of gains are we looking at?
Well, again, how Malaysia does very much depends on how Asia does in general, and to that end, we are generally positive for Asia this year. We do believe it's going to be a reflation cycle for the world as well as Asia this year, helped by a global synchronized recovery where economies will pull each other up. As a result, there'll be a lot of positive news flow, macro and micro, for Asia in general, and as they say, as the tide comes in, all boats will be lifted. So Malaysia should do reasonably well. However, being a low beta market, it will continue to underperform in our opinion. So what we saw last year in terms of its underperformance, but yet positive performance, we're likely to see more of that this year.
Okay, but can you quantify that for me, Johan? I mean, I'm sure we're not going to see 53% gains in 2010. No. So what's likely for this year?
Quite well. I mean, markets have come a long way, but I'm talking Asia in general. But still, Asia is still about 30% below its October 2007 peaks. And again, we still feel there's a lot of upside there, especially given that corporate earnings has only fallen about 18%, and given consensus expectations of about 20–25% for earnings growth this year, you're going to see Asia's corporate earnings going to exceed 2007 levels. So all of that basically pretty much implies that you are going to get multiple expansion in Asia generally, and that is justified, and that's going to be the same for Malaysia as well.
Okay, well, we just had a guest earlier on in the program calling for a 30% plus correction. Also, OSK Research says a rally will end in April or May as a risk aversion might set in. What do you think of these calls?
Well, okay, first of all, as far as the full year is concerned, we reckon 15 to even 20% total return for the whole year is basically reasonable and is realistic. However, we also reckon that mid-year there will be an interim correction, and the main reason for that is because it's a reflationary year, you are going to get some unwinding of stimulus measures, number one, and number two, it is going to be an inflation year as well. And with inflation, it's going to be the inevitable rise in interest rates. And the thing is, markets will never take these 2 points lightly, and it's likely to perhaps see an interim correction sometime in mid-year. You want to compare that, as far as market psychology, to what happened in 2004, when U.S. rates started to rise from 1%. Markets basically corrected. Asia corrected about 20–25% somewhere mid-year, and it always does that about 2 to 3 months in advance. However, after that, the markets do actually have a good chance of resuming their positive trend, provided that corporate earnings continue to be positive. And again, it's not going to be a straight line as far as positive returns for this year. There will be a dip intra-year, but net, it should be a pretty good year this year.
Okay, so Johan, OSK making that prediction that we're going to see a midterm correction, and it says to buy these big dividend yielders in Malaysia this year. Names such as Telecom Malaysia, Yilai, also Berjaya Sports Toto. These stocks have dividend yields of 8 to 9%. Do you think that's the best play in the Malaysian market?
I think it's a bit too early for that. I mean, we do have some dividend yield plays in our portfolio as far as Malaysian stocks are concerned, but generally we are pretty much overweight on the banks, in particular CIMB, will like it very much. You have three drivers of earnings there. Generally stability in net interest margins, loans growth, as well as fee-based income, not to mention loan loss provisioning, which should actually start falling this year. All of this will speak very loudly to the bottom line. Also, we like plantations. But on the dividend yield side, we do like Maxis, for example. I had mentioned this before the last time I was here. You have indicative dividend yields of 9 to 10%. And if you assume dividend yields being compressed to about 6-odd%, you're looking at price target about 660 from current levels of 535. So Maxis is probably one of the dividend yield stocks I'll probably have in my portfolio. However, it's still going to be very much growth emphasis for now.
Yeah, now, Johan, you said 18 to 20%, pretty good, actually, for 2010 in terms of stock gains. Is that pretty much where you're expecting Malaysian stocks to head as well?
Well, we expect Asia in general to do about 15%, then Malaysia, by being a low beta market, should do less than that. So we're looking about between 11 to 12%.
Okay, let me just ask you, where's a better place to put your money then? Because it seems like Malaysia doesn't have as much firepower in the market as elsewhere. Last time you were on, you were talking about Hong Kong, you're talking about India, you're talking about China. Are these still the markets you're looking towards in 2010?
Yeah, absolutely. I mean, we are still in the early stages of reflationary cycle, and where we are in the cycle, it's always prudent to be in the high beta markets, and especially when you're focusing on financials, which includes property as well as commodities, then you probably want to be overweight in markets like Hong Kong, Singapore, China, India, and to some extent Indonesia as well.